Good afternoon everyone and welcome to the Morrows Monthly update for June. The old adage of sell in May and go away has so far held true for 2013, with June seeing negative returns across most asset classes. This was largely on the back of discussions from the US Federal Reserve over potentially withdrawing stimulus programs earlier than expected, and also a potential credit squeeze out of China. The Australian equity market fared better than most of its global peers during the month, falling by around 2.5% in June. Europe was down 5%, Japan was down 4%, and China was down a significant 16% for the month. The US was the best performing market, falling by around 1%. Discussions from the US Federal Reserve about tapering back its stimulus programs resulted in bond yields rising significantly across most economies. The one exception to this was in Japan, which saw a slight decline in bond yields. Commodities were generally weaker across the board on the back of continued strength of the US dollar. Gold prices were down about 10%, however we did see oil prices finish stronger by around 5%, and surprisingly iron ore prices also higher by 4%. The US dollar rose relative to most major currencies, and this did see the Aussie dollar depreciate by around 3% relative to the US. After several months of weak economic data out of the US, the month of June was more upbeat, with consumer confidence and retail sales rebounding. The housing market continues to strengthen, however the one negative was a weaker than expected manufacturing report. In Europe, economic data was also positive, although expectations were low. We saw stronger than expected manufacturing and industrial production reports, however retail sales came in slightly less than expected. In China, we've now seen several months of weak economic data, with manufacturing, industrial production and retail sales all missing estimates. We have seen, however, the potential for a credit squeeze within the banking system within China, and that is something to watch. In Australia, what we've seen is mixed data continue. We saw a weaker than expected first quarter GDP growth number. However, this was offset by a better than expected labour force number, with the unemployment rate falling to 5.5%. At its July meeting, the RBA left interest rates on hold, although forecasts are for further rate cuts to come. The month of June saw correlations amongst most asset classes rise significantly, and we saw this with both defensive assets and risk assets both selling off together. This highlights the importance of having real diversification within portfolios, particularly in times of market stress. Our downside risk protection strategies have worked very well over recent months, and we continue to favour these strategies in what we see will be a more volatile period going forward. The outlook for markets is uncertain, and whilst markets can continue to rise, the downside risks are also quite high. We thank you for your time, and we look forward to talking to you again next month.